Cash is considered to be a highly desired asset, and as a result of this, businesses typically implement several safeguards to protect their cash and accurately disclose it. This is where bank reconciliation comes into play. Well, what is a bank reconciliation? A bank reconciliation is defined as a method of consolidating the disparities between the cash balance on a bank statement and the cash balance on the records of a business. So why is a bank reconciliation so important? Bank reconciliations are critical internal control mechanisms for avoiding and discovering fraudulent activity. They also assist in the identification of accounting and banking discrepancies by illustrating the inconsistencies between the cash balances on the accounting ledger and the bank balance status on the bank statement. To do a bank reconciliation, you will compare the cash amounts on the balance sheet to the equivalent figure on the bank statement, identifying the inconsistencies in order to make adjustments to the accounting statements, correct any anomalies, and detect fraudulent transactions. The bank reconciliation is prepared in the process of 3 different steps. Firstly, we must reconcile the bank balance to the actual cash balance, so the main objective of this first step is to get the adjusted bank balance to equal the actual cash balance in our business records. So the easiest way to do this is to accept those items that we see in our cash records and our bank statement, and then to eliminate those items that do not match, as these items will either be deposits in transit, outstanding checks, or errors in the bank statement. The second step in the bank reconciliation process is to reconcile the business book balance to the actual cash balance. The 2 main reasons why this may occur are 1. When the bank notifies the business of an addition to the cash balance, this is a credit memoranda, which contains either the collection of receivables or the interest on notes. And 2, we have our debit memoranda, which is a notification of a subtraction to our cash balance. This can include fees charged by a bank or a non-sufficient check. Thirdly, we must adjust our business book balance to our actual cash balance, in which we can then record our adjusted bank reconciliation once both the cash balance equals the bank statement balance. We then record and prepare the journal entries for the credit and debit memoranda.